We know that building credit is really, really important. Having a great credit score affects your ability to get credit. The rate that you pay could affect you with renting an apartment, getting a job. It's so, so important. And yet there are a lot of misconceptions out there about what it takes, how it all works. And these are questions that I get asked all the time. I know our next guest gets asked these kinds of questions all the time too, given what she does for a living. Becca Mintz is Vice President of Credit and Data at Capital One Canada, and she joins us now to talk about some of these myths and misconceptions. Hello there.
Hello. Thank you so much for having me, Bruce.
It's like the cocktail party chatter. People will, I'm sure they do the same for you. They'll like pull me aside and like, I don't know about this. I don't know about that. So we're going to get into like some of the top ones that I hear all the time. I'm sure you hear all the time. Number one being checking your credit score hurts your credit. People don't understand the difference between a soft pull and a hard pull. So take that one for us.
Perfect. It's a great question. Checking your credit score cannot negatively impact your credit score. It's important actually to keep an eye on your credit score. It's kind of like when you wear a fitness tracker to keep an eye on your steps. It's one of those what gets measured gets done kind of situations. So I actually strongly recommend keeping an eye on your credit score. Capital One has a tool called Credit Keeper. That's one that allows you to actually go look and see how's my score changing over time, depending on what I do with credit. Now, you mentioned something called a soft hit and a hard hit. Let me share a little bit more about that.
Yeah.
So when you take a soft hit, that's just looking at something. It's doing a check. That doesn't actually impact the score itself. A hard hit is when you're actually applying for credit. So you've applied for a mortgage or a car loan or a credit card, for example, and that is called a hard hit or a hard inquiry. And that in and of itself, especially if you have a bunch of them, that can impact your credit score. So soft hit, totally safe. Hard hit can impact your credit score.
And hard hit because lenders can get a little concerned if you're going all across town saying, give me a loan, give me a loan. So that's what makes the algorithm go a little crazy.
Yeah, you're exactly right. There's no need to worry if you're applying for a credit card or, your mortgage or whatever it is every so often. But you're exactly right. If we saw someone applying for all sorts of things all of the time, that might be an indication that something was up.
Right. Number two, you need to carry a credit card balance to build credit. People ask me about this. They don't even ask me. They tell me that this is true. You and I know it's not true. So let's correct the record.
It is definitely not true. And in fact, we always recommend being responsible with your credit. And for you, if that means spending and paying that down in full, then that's definitely the thing you should be doing. The way we think about it is responsible credit habits. So making your payments on time every time, that's the most important thing. Whether that's your minimum payment or your full payment, that's up to you. But that is not the thing that affects your credit score.
When people do look at their credit score, very often they're quite surprised, they're disappointed, they can feel hopeless. And there is a myth that once your credit drops, it can be virtually impossible to rebuild it. Also, not so.
Not so at all. And that one, really gets me in the gut. When we speak to our customers who have felt that kind of frustration or that hopelessness, it's something I'm really proud of working at Capital One for, is that we give people, a second chance or that opportunity to rebuild their credit when they've had challenges in the past. The best way to rebuild your credit is to start responsibly using credit again within your means and to demonstrate that track record of responsible credit use. So that means paying your bills on time every time, not borrowing more than you're capable of repaying, all those sorts of good, healthy credit habits.
And you're rebuilding trust. I mean, metaphorically, that's what you're doing. That plays out in the data. Trust can take time to rebuild. So how would you manage people's expectations in terms of like, I'm paying my bill on time every time, but that's not 2 months. That's what? Is it 12? Is it 24 months? How would you have them broadly think about how long that takes?
Yeah, I wish there was a magic recipe. The way that credit bureaus look at it for the sake of producing a credit score is they look at a bunch of different factors. So they look at how many different types of credit you have, how much you're borrowing, your payment behaviors, all sorts of different things. And there's a bunch of different combinations of things that can lead to your credit score increasing or decreasing over time. So it's not as straightforward as saying it's, a recipe of exactly this for this many months. However, I will say that if you are responsibly using credit, certainly by the course of a year, you would expect to see increases in your credit score, if not sooner than that.
People have a view that, or a belief that income affects your credit score. Either, oh, my income's too low, I'm gonna have a terrible credit score, or my income's really high. Why do I not have a perfect credit score? correct the record.
I can tell you've been to some interesting cocktail parties, Bruce.
Yeah, yeah.
Um, Income is not directly a factor in your credit score. So when the credit bureaus calculate your credit score, income is actually not something that they're directly looking at to put in your credit score as a variable. However, income, of course, is a factor in how all of us manage our financial lives. And so when we think about how much debt can I genuinely afford to have, what type of credit limit is appropriate, what type of spending, income is a factor for ourselves. So while it may not affect that number itself, it certainly should affect how each of us as individuals has that relationship with credit and whether I can really afford to buy that thing on my credit card or not, and whether I can pay that down.
Here's one I got quite recently from a person who was employed, successful, had their own mortgage, and her myth was, I need to keep my available credit as low as possible. So even though she had all the great things that would allow her to qualify for a pretty solid limit on her credit cards, she chose to keep them very, very low because she thought that was better. An inaccurate interpretation of how that works.
Yeah, that's an interesting one. I can't say I've heard that one myself. The way I think about it is you want to be demonstrating, responsible use of credit. And so that isn't inherently tied to a number or a credit limit or an amount of available credit. I think a watch out here would be that if you're using every single dollar available to you across every single, potential credit option, like a credit card and a mortgage and an auto loan, et cetera, that might make a lender nervous because you'd be
Yeah.
saying, gosh, Bruce already seems like he might be at the maximum here. What's going on there?
Yeah.
But the premise of keeping it low in and of itself is neither good nor bad inherently for
Yeah.
your credit score.
Her view was that it would protect her against fraud. So if the fraudster came, they'd only
Ah,
be able to take her for 5 grand. And if she had 15 grand available, then they'd take her for 15. Where that, just linking to another idea, is around utilization. So I had her go look at her credit score. And what she saw, not surprisingly, was that her utilization was really, really high because she, has kids and she uses her credit card. And I'm like, no big
sure.
deal. Of course it's high because she has so little credit. The misconception a lot of people have is that utilization, so that percentage of credit used, is only on an outstanding balance, which,
Mm.
and you'll correct me if I'm wrong, when in reality, it's at a point in time. So if you just put like a big trip on your credit card and the bureaus look at your file on that day, you might have a very, very high utilization.
Yeah, the way I think about it is like an average. And so if you take the spend that you have on your credit card over the course of a month and you were to deduct any payments that you're making, if you were to take like the average daily balance, for example, that isn't necessarily about whether you paid it all down or you carried it over to the next month. It's just looking at over the course of that month, how did you use credit and how much spend you had on your card relative to how many returns or how many payments you made on that card. So myth debunked in the sense of you do not need to carry a balance in order to build good credit. And in fact, often it's most responsible for people to pay down in order to rebuild their credit and use credit wisely.
There's also a misconception that everybody reports to the credit bureaus, but there's some notable exceptions. I mean, you've got some, let me throw one out there, is sometimes secondary lenders don't
Mhm.
report to the credit. So an alternative mortgage lender, for example, you think your mortgage is a part of your credit file, and it may not be if you're borrowing from someone other than a big bank. What are some other examples that you know of?
One that comes up often for us around credit bureau reporting is for folks who are new to Canada and wondering if their credit history in a different country, for example, ported over. And generally the answer is no. Or students, for example, my first ever credit card was actually an authorized user's card on my parents' credit card for in case of emergencies.
Yeah.
They defined what emergencies was. Otherwise, I think my definition of emergency as a teenager might not have been 100% aligned.
Yes.
But in my mind, as a 17-year-old or 18-year-old, I had a credit card. I must have been building credit history. But in reality, having that authorized user card on my parents' account had nothing to do with me, and I didn't
Yeah.
actually have a credit card account
Yeah.
at that point in time, and I thus wasn't building credit history in that
And
moment. And so
and
those are a couple
some
that come to mind.
some bills are and some aren't. So
Yeah.
utilities, maybe, cell phone, maybe, maybe not. If you're super reliable on paying your cell phone bill, that may not help. But what could hurt you is if that bill goes to collections. Fair to say that?
It is fair to say that some telecom companies do report to the bureaus, and that you can missed payments can affect your credit score. When in doubt, I definitely recommend asking. So if
Yeah.
you are looking at a new product or service and you're wondering whether or not this is actually directly reporting to the credit bureau, because either you're excited about that ability to establish credit history or you're worried that there could be something that's unfavorable there. When in doubt, I would always ask the question, and you should be able to get an answer from most reliable products and services.
My last one here, the misconception that people have that their credit file is always going to be accurate. And that is just, I mean, everybody's doing their best, but that is not the case. What are some of the errors or omissions that you hear about that people only discover if they do the work to get the score and look at the underlying credit report?
I mean, I think the keeping an eye on it is so important. Having tools like Credit Keeper that actually allow you to go in. This tool for us is not just about score tracking. It'll actually show you like all of your open trades, for example. It'll show you a bunch of things about your credit history and the patterns of how you're using credit, not just on your Capital One card, but across your whole credit file.
Mm,
And so, I strongly, strongly recommend people use a tool like Credit Keeper to keep an eye
yeah.
out. You mentioned the woman at the party, for example, that was talking about fraud or someone having issued credit in their name that really caught them by surprise. And one, I hope that there's other ways people will find out, but one way you can find out is by keeping a really close eye on your credit report. And so, when you look in Credit Keeper and you're like, gosh, I don't remember getting that. And it forces you to pause and ask yourself, is that accurate or inaccurate? And then you
Yeah.
can take an action. But if we're not keeping an eye on things, it's really hard to feel that level of confidence and feel like we're in control. And so I strongly recommend keeping an eye on your credit score and your credit report.
Really helpful stuff. Becca, thank you for joining us today.
Thank you so much for having me.
Becca Mintz, Vice President of Credit and Data at Capital One Canada.